All right, today is Thursday, February 17th, and this is a recap for the stock market activities today. Folks, I got a good one for you tonight, and boy, do we have a lot to talk about or what. What a bloodbath in the stock market today. So buckle up your seatbelts, and here it is, in focus tonight. Let's talk about a market advice that I have for you guys. And then let's talk about the Russia-Ukraine tensions, and lastly, a dire warning from Charlie Munger about inflation. Let's start by the stock market advice. You and I know, and we've been talking about this ad nauseum, this channel. We know that the stock market mania was fueled by the Fed's cocaine operation, the trillions and trillions of dollars in liquidity that enabled the retail crowd, the mom and pops, the institutionals, and the likes to pour billions, if not trillions of dollars into the stock market blindly. And now that the cocaine operation is coming to an end, the stock market bubble is collapsing. Okay, we all know that by now. Hey Maverick, stop being redundant and tell us something new. Tell us something we don't know. Here's something new. Let's talk about breakfast recipes. Okay, I'm just kidding, but here's something new for you. Besides the cocaine operation, we have two fundamental reasons behind the rise in stocks. Reason number one, the stimulus. Reason number two, inflation. Stimulus was the fuel, the tailwind for certain stocks in the market to move higher. And then we have inflation as another tailwind that benefited a basket of stocks in the market. What I want you to do, go through your portfolio, look at stocks in your portfolio, and ask the question, is this name a beneficiary of stimulus or inflation, or perhaps both? But by the way, you're not going to find a lot of names that benefited from both. But here's the thing. If the stock that you own in your portfolio, if the main tailwind for this stock is stimulus, then forget about that stock. It's done. It's over. For example, look at the stock of Shopify. We talked about Shopify in yesterday's video. Is Shopify a beneficiary of stimulus or not? The answer is, of course it was, because trillions of stimulus went into retail spending, sometimes in Shopify's platform. Is Shopify a beneficiary from the rise in inflation? The answer is no, absolutely not. We looked at the earnings from Shopify yesterday, and the name is getting whacked by inflation. So here's the take. The stimulus tailwind is over now. It's gone. It no longer exists. Meanwhile, the headwind of inflation is still here when it comes to Shopify. So you have a stock that is getting hammered by a headwind that we call inflation, yet the tailwind that pushed the stock higher, stimulus, is no longer here. These are the kind of stocks that you want to get rid of before it's too late. And we say that, by the way, because you might have noticed that retail spending got a nice bump due to the stimmies. As you can see from this chart, we had stimmies round number one back in 2020 from the Trump administration, and that fueled the rise in retail sales. Then we got stimmies round number two, courtesy of the Biden administration, and that pushed another leg higher in retail sales. But after that, there is nothing. Retail sales calmed back down. The retail spending mania is over now. So, what does that mean when we talk about stocks? Certain stocks that benefited from the stimmies, they saw their revenues, their profits surging higher in 2020, 2021. Now that the stimmies are not here, it is pretty much impossible for these corporate earnings to match the performance from 2020 and 2021. What does that mean? Their stocks will go down, and in certain cases, they will perhaps erase the entire gains from the pandemic. Case in point, Fastly. Look at this stock. What a massacre. Let's do another stock. How about Alcoa? Did Alcoa benefit from the stimmies, the tailwind of stimmies? Maybe, perhaps. Nobody got their stimmies check and they spent that on buying a ton of aluminum. But maybe they spent the stimulus buying goods that are produced using aluminum. So perhaps it is an indirect tailwind for Alcoa. But is inflation a tailwind for a name like Alcoa? Of course it is. The rise of inflation pushed aluminum prices higher, and the stock of Alcoa also surged higher. Is the tailwind of inflation still with us? The answer is yes, it is, at least for now. It's not going to be with us forever. At some point, the Fed will have to act, and they might act aggressively. That will indeed hit inflation hard, and it will hit Alcoa stock hard. So for now, when I manage portfolios for my clients, I see all of this ahead of time. Therefore, back in November, I told them if you have names like Shopify, Etsy, any of these names with direct exposure to the consumer, all of these names that benefited from the tailwind of stimulus, you gotta get rid of these stocks from your portfolio. Matter of fact, you might want to short them. On the other hand, if you have stocks that are inflationary, that benefit from the tailwind of inflation, you still want to keep these stocks in your portfolio. So far, this strategy has been working tremendously. Now, let's say that you're scared of stocks right now. The volatility is just too high. You want to park your cash somewhere. And perhaps you say cash is trash. It is not an option because the longer I'm holding on cash, the value of that cash gets diluted due to the rise in inflation. Where do I park my cash? How about a thesis that I shared with you back in December? And this thesis is the rise of the old man, the sleeping giant, gold. I parked some cash over there, specifically in gold miners. I picked New Mount Gold. You can pick whatever you want, but let's go back to that video from December and hear what I said about a name like New Mount. Take a listen. Somebody asked me about gold miners. Let's cover some gold miners. Starting with the ticker NEM for New Mount, we have 53 as support. This line has been tested over and over and over and over again. Ask yourself a question here. If the chart wanted to trade below that number, it had plenty of opportunity. Why would it break that support line right now? Does it make sense? If anything, it means that we have a solid support. We have a process of gathering of energy from this consolidation. That energy will be released to the upside. And here's the update. If you listen to your uncle, the Maverick Wall Street, you made a cool 16% or so. And by the way, you're also going to capture a dividend of over 3%. On the other hand, you have everybody screaming and yelling about the stock market crashing, yada, yada, yada. You don't like New Mount Gold? You can buy other gold miners. We heard from Barrick Gold yesterday, or this week, I should say. They're hiking the dividend. The earnings are pristine. You can buy gold futures. Gold is a good asset for now to park cash in. Nobody loved gold in the last 2 years, but we knew that there will be time when gold is going to become sexy again. And perhaps we're already there. So anyhow, this is the advice that I got for you. Look at your portfolio and ask the question, what is the tailwind behind the rise in the stock? Was it stimulus or was it inflation? If it is stimulus, get the hell out before it's too late. If it is inflation, you might want to hold on these stocks, but also sell calls, buy puts before earnings, for example, lighten up after big moves, because there will be time when inflation is no longer a tailwind that we can rely on. Next, let's talk about Russia-Ukraine, because yesterday it appeared that we have a lid in the wall of worry when it comes to Russia. Well, today it appears that the lid has been ripped off. It's no longer here, because apparently, despite the news of de-escalation by Russia and removing troops, the United States disputes all of that. Matter of fact, the US government says that the Russians are actually adding troops. Now, I don't trust the Russians or Putin. I think he's playing games. You and I know that. But I don't trust our side either. I think our side has been jerking off to this war. They want it so bad. Matter of fact, CNN already have correspondents in Kiev, Ukraine. They're waiting for the war to happen. They're hoping for the war to happen. And the propagandist media is already there. You know, they're telling you that the Russians are already shelling kindergarten schools in Ukraine, yada, yada, yada. And you're going to hear a lot of these stories if the war actually happens. And when that takes place, the public will be enraged, the Russians are monsters, yada, yada, yada. All of that's done by design, of course, so anybody counters the narrative of the oligarchy, they will be labeled as Russian puppets and propagandists, yada, yada, yada. Let's seize their bank accounts. You know where I'm going here. But our concern from this story in this program is economic and stock market related. We have a call from Morgan Stanley that says, buy the dip. The Russia-Ukraine tensions, that's an opportunity to buy the dip. At some point, the SEC has to wake up from the coma, because this is the same Morgan Stanley that just a couple of days ago, they sent out their top dog, Mike Wilson, who came out and said, we're going to see a polar vortex in the stock market. The sell-off is not over yet. Prepare for ice and fire. So who do I believe? Morgan Stanley or Morgan Stanley? I say watch out here. The pumpers, they're predators. They're wolves in sheep's clothing. So be careful here. Follow what the market is saying right now. When we first heard about the Russia-Ukraine tensions escalating to the point where we have an imminent invasion, what happened? Stocks went down. And the four assets that took a massive leg higher were number 1, gold, number 2, crude oil, number 3, wheat, number 4, palladium. And then when we heard that perhaps we're seeing de-escalation in the Russia-Ukraine tensions, guess what happened? Gold went down, crude oil went down, palladium went down, wheat went down, and stocks shot up higher. What do we have today? Stocks went down again, big time. Gold went higher, palladium went higher, wheat went higher, but crude oil did not go higher. So the message from the market is, watch out, the tensions between Russia and Ukraine is not over. But what's up with crude here? Why didn't crude move higher? The answer is we have talks of a nuclear deal with Iran. Why is this important? Hear me out here. The Biden administration is absolutely desperate to tackle inflation. And the poster boy for inflation right now is energy prices, specifically crude oil prices. And the concern is we're seeing many analysts and strategists saying that perhaps crude oil prices will hit 100, even 150 by the summer. Now, the Biden administration tried before to tackle this problem by releasing barrels from the strategic reserve, and that fired back big time. So now, what do they have? What is the other alternative that the Biden administration has right now? How about releasing millions of barrels reliably and sustainably from one of the largest producers of crude in the world, Iran? And hence, all of a sudden we have a nuclear deal. So that took crude oil down today. But there is another problem with that. What if Israel doesn't approve of the deal? What if Israel decides to hit Iran before any deal happens? That will push crude oil higher again. I'm not sure where Israel stands with this deal. Do they approve? Do they not approve? From what we know, we have tensions between the Biden administration and the state of Israel. And therefore today, on the same day that we have talks about a nuclear deal with Iran, the U.S. sent the third in line, the Speaker of the House, Nancy Pelosi, to Israel to calm them down. And where is the Vice President, you might ask? I have no clue. Do we even have a Vice President, folks? I'm not sure. But anyhow, the point being here is crude took a leg down. But will we see another attempt of buying the dip? That will be confirmed if the Israelis come out and say, hey, we're not cool with this deal at all. Then crude prices will recover. And if the Russia-Ukraine tensions escalate, now we have double tailwinds for crude oil prices to move higher. And oh, by the way, don't forget that OPEC is in control of the supply here. Let's say Iran comes out with millions of barrels out based on a deal. OPEC could respond and say we're going to cut supply. So regardless, the tailwinds for oil remain here with us. And that means we haven't seen the end of inflation yet. And that leads us to the third subject of this video, which is the warning from legendary investor Charlie Munger, who I consider to be the greatest investor in history. People say it's Warren Buffett, but again, Warren Buffett would not be possible without Munger. And of course, we know the old man talks brashly about a variety of subjects. He talked about inflation, he talked about the Fed, he talked about jabs, he talked about cryptos, of course. So let's hear some of the opinions that Munger shared with us yesterday. Apparently, Charlie Munger still likes Apple and Chevron at this point. Matter of fact, Berkshire Hathaway continues to add to their Chevron holdings. Excellent dividend, the tailwinds for oil are still intact. It is no wonder why Berkshire Hathaway likes the name. But here's what Munger said. Munger told Yahoo Finance why Berkshire ramped up its Chevron stake by a third in the fourth quarter. The conglomerate has a boatload of cash to deploy, and a 4% dividend from Chevron is more enticing than a 1% return from bonds, he said. So now he's starting to pick up on his brain that Berkshire Hathaway is picking high dividend stocks at this stage. And by the way, Berkshire Hathaway outperformed the market tremendously in the aftermath of the dot-com bubble. So we have to look for high dividend names with reliable cash flow. Chevron is a name, AbbVie is another, Procter & Gamble, Coca-Cola, you get the picture. Old school names will outperform in this market. Continuing. Now Munger is talking about the Fed. In the interview, Buffett's right-hand man suggested the Fed went overboard in its efforts to buttress the economy during the thing. They just threw money at the problem, Munger said. He also added they were probably right to fear what was going to happen and be quite liberal in throwing money at it, but they probably overdid it a little. A little? I say overdid it by a lot. And this is why we have an inflation problem. You gotta fix all of that overdoing in the stimulus and the cocaine operation. On cryptos, Munger said that he understands crypto, but still hates it, sees the excitement around Bitcoin and other tokens as a bad thing, and consider it a huge mistake to allow it at all, quote-unquote. The billionaire investor bemoaned the number of people gambling widely in the stock market, while long-term investors are looking for quality businesses and companies are seeking to raise capital. He described the cocktail of interest as speculative orgy, quote-unquote, that is dangerous for the country. Why is it dangerous? I have a theory. Bear with me. Again, on crypto, Charlie Munger says that he was not surprised by crypto's recent surge in popularity, noting it is an ideal currency if you want to commit extortion or kidnapping or a protection racket, quote unquote. Now, yes, we have a lot of scams, a lot of crimes using cryptos, but the majority of Bitcoin investors see it as an asset to hold in their portfolio. I disagree. I think there is no value for Bitcoin. Matter of fact, I call it tulips, but hey, everybody's free to hold whatever they want. The crime element is going to become relevant, by the way, because now with the protests that you're seeing in Canada and sympathizers sending donations using cryptos, wait for it, they're going to call cryptos a tool for terrorism. And oh yeah, they're going to ban it for sure, 100% now. Continuing. He questioned why governments should welcome an untraceable technology into their payment systems, run by, quote, a bunch of people who want to get rich quick for doing very little for civilization, end quote. Munger, of course, called cryptos as rat poison, specifically Bitcoin. I have my criticism against Bitcoin and cryptos, but the untraceable part is the sticky subject here. The appeal for many investors and traders of cryptos and Bitcoin is the fact that it is decentralized and untraceable. The counter to that is give it a little time and they're going to ban it, or they're going to make it traceable and they're going to hold full control of Bitcoin. Otherwise, it's going to be banned, folks. 100%. And oh, by the way, Bitcoin is not really that decentralized. We have a handful of people who control pretty much the majority of wealth in Bitcoin. So just keep that in mind. On the working culture, Munger says that we're not going to see a return to the 9 to 5, 5 days a week in the office. That's not going to happen again. These days are gone, they're over. And this is a good development for workers and labor because it gives us more time to stay with our families. It gives us more time not to be overworked corporate slaves, most importantly, underpaid. And when we have labor shortages and wage inflation, you want to keep your workers as happy as much as you can. And having a shorter working week and flexible hours, a hybrid working model from home, from the office, this is the future. It's going to be with us, no doubt about it. Now, here's the most important part in Munger's commentary, and it regards inflation. Munger says inflation can be the way democracies die. And this is an important take, and here's Charlie Munger in his own words.
You mentioned inflation, Charlie, and the stock market is down a bit this year, maybe because of inflation, also the tensions in Russia and Ukraine. Maybe we'll get to that in a second. But I want to ask you specifically about inflation. Are we looking at a prolonged decline in the markets because of inflation? Is inflation on the rise, and should we be concerned about it?
Well, let me take that in the reverse order. Inflation is a very serious subject. You can argue it's the way democracies die. When democracy dies in Latin America, inflation is a big part of it. So it's a huge danger once you've got a populace that learns it can vote itself money. If you overdo it too much, you ruin your civilization a lot. And so, of course, it's a big, long-range danger. If you look at the Roman Republic, and even after they went to an empire with an absolute ruler, they inflated the currency steadily for hundreds of years, and eventually the whole damn Roman Empire collapsed. So it's the biggest long-range danger we have, probably, apart from nuclear war.
Is it something investors need to be worried about, specifically when it comes to growth stocks right now?
Well, I think the safe assumption for an investor is that over the next 100 years, the currency is going to zero. That's my working hypothesis.
Wow. Well, that'll be a different type of environment, won't it?
A very dangerous environment.
And I had to cut it short, of course, because Munger was talking about the guy with the funny mustache.
Easy. Oh. Thought it was the old Germany.
Right? No, it's not.
And if I left it there, the robot police will go, what? What is he saying here? Should we ban the video or what? But you get the point. It's amazing to me. Almost 100 years later, we're still talking about the same guy. By the way, we're going to talk about him again in the charts analysis when we talk about Tesla, because Elon Musk, aka Reverend Elon Musk, got in a lot of trouble today. Anyhow, back to Charlie Munger and inflation. The threat of inflation is now becoming more than just economic. We're talking about the end of democracy as we know it. And is inflation slowing down? Of course not. We got the PPI yesterday, the Producer Price Index, which is a leading indicator for the CPI, the Consumer Price Index. And the PPI surged higher once again. So there is no stop in sight in this inflation. And here's why I say there is a theory behind the end of democracies and inflation being the catalyst for that. It starts with a populist backlash, and then it morphs into civil unrest, and then it evolves into a revolution, and that revolution becomes civil war. This is the danger here, and of course, once again, thank you to the Fed led by the delusional madman Jerome Powell. How will the populist backlash start? Well, we talked about retail investors and the stock market. When the stock market crashes, and it's already crashing by the way, we're going to look back and say, wait a minute here. The rich, the insiders, dumped their stocks at the top. They all became filthy rich. Meanwhile, us retail investors are left with the short end of the stick. But again, the majority of Americans have no exposure to the stock market, at least direct exposure, besides their retirement accounts. So this is not going to be a major populist backlash. But the backlash from the economic collapse, the upcoming recession, and perhaps depression will indeed be problematic. And here's perhaps a hint of how it's going to happen. Listen to this headline. It reads, as inflation pushes prices higher, the poorest Americans have less cash to spend than before the thing. Wall Street has taken notice. So we're already seeing the oligarchy. The rich are doing fine. They're living in the roaring 20s. The poor, the middle class, they're suffering. We're starting to see the class warfare, the divide between the rich, the poor, the middle class, and this is a dangerous development, not just in this country, by the way, but historically speaking, in any country. You don't want the peasantry pissed off, because this is a recipe when the pitchforks start to come out. Another one, the headline reads, inflation is making seniors choose between food and medications. Wow, unbelievable. Look overseas, it's not just in the US. Look at the UK, the highest inflation in 30 years. It is causing a cost of living crisis in the United Kingdom. Matter of fact, right now we're seeing the biggest fall in living standards for at least 30 years in the United Kingdom. Meaning, if you are a millennial, if you are under 30 years old, maybe 40 years old. This is the lowest standard of living that you've ever seen in your life. And comes April, by the way, the cap on energy prices will be lifted, and we will see millions of households dipping into poverty. So it is already bad to begin with, but it's about to get even worse, because we will see the financial event of the century, which is the unwinding of the greatest experiment in financial history, the quantitative easing, the cocaine operation. That is coming off due to out-of-control inflation. The Fed will have to tighten the monetary policy aggressively, and this will cause a recession. A recession has been always the cure to inflation. But what if inflation doesn't respond to aggressive tightening? Then the Fed will have to tighten even more. And perhaps we will see a recession morphing into a depression, the likes that we have not seen since the Great Depression almost 100 years ago. Then we're talking about a massive populist backlash, a massive civil unrest, perhaps a revolution. This is a dire outlook, folks. You better hope that we will never get there. But unfortunately, the leading indicators don't look good at all. Take a listen to Carl Icahn, who predicts that the Fed's money printing party will end badly because the government cannot control inflation. And now traders are pricing in a chance of the first back-to-back half-point rate increase since 1994. What does that mean? 50 basis points increase in March, and in the next meeting, another 50. What do you think that will do to the stock market and the economy? We will go from shock and awe to just destroy. Grab the flamethrower and destroy everything right now before it gets worse. Market participants are now placing a lot of bets that we will see a 75 basis points increase in March and a minimum of 150 basis points increase by the end of the year. Today, we also heard from James Bullard, the St. Louis Fed president, who came out and said, doubled down actually on his previous take, which is very hawkish, by the way. Now he says we have to front load interest rate hikes. So if it is 150 basis points, we have to use 50 right now, maybe more than that, perhaps 75 right away. Front load those interest rate hikes so we can restore confidence in the Fed. You think that's going to happen without a stock market crash, without an economic dip into a recession? Think again. He also talked about unwinding the balance sheet for the Fed. So now you're starting to see why Munger is warning about inflation. They could end democracy because we will see a lot of destabilization in societies, plural, not singular, in the US, in the UK, in Canada, in Australia, across the globe. The biggest destabilization of societies that we've ever seen perhaps in our lifetimes. But rest assured, the oligarchs have another trick up their sleeves. They don't want you to blame them for all of this because the oligarchs hold the responsibility behind all of this financial engineering of the system by the Fed that benefited them the most and gave the rise of oligarchy in this country. They want you to blame all your miseries on your fellow man, right? Specifically the unjabbed right now. That's the trick that they have up their sleeves today. And look at this. When we talk about civil unrest and people going on at each other's throats, listen to this. And it is absolutely terrifying, by the way. The headline reads, nearly half of Dems, meaning Democrats, say fines, prison time is appropriate for questioning the jabs. Wow, another one. Nearly 30% of Canadians support jail time for the unjabbed. Unbelievable. And I bet you're at least going to find 1%, 1 to 3% who say, let's just kill the unjabbed. And you wonder why UCSD scientists are now predicting a warning that the US is heading toward a civil war. But is your fellow man really the enemy? Or is it the oligarchy that is behind all of these miseries? The oligarchs who don't pay taxes, they have no problem taking trillions and trillions of dollars from the future of this country by the Fed printing money out of thin air, propping up stocks, and then they dump, cashing in billions and billions of dollars, but they don't pay taxes. And it is getting absolutely absurd. For example, today we heard from another oligarch, Eric Schmidt from Google, who says the US is way behind China in 5G and technology, and he blames the government for not spending more taxpayer money. How much more do you guys want, the oligarchs? You already got trillions of dollars. How much more? And is the taxpayer and the government really responsible for this country being behind China in technology, or is it the trillions of dollars that corporate America, but specifically technology corporations, spent on stock buybacks? Yep, to prop up these stocks higher so the insiders can dump and get richer. They could have used these trillions in R&D and technology infrastructure spending, and if they did that, by now we would be light years ahead of China when it comes to technology. But no, they want another handout from the taxpayer. Chip manufacturers, look at Nvidia's earnings, for example. Profits like we've never seen before. Yet they want $50 billion plus from the taxpayer to build factories here in the US. More welfare, more socialism for the rich. And corporations, of course. And hey, Eric Schmidt, you want to blame somebody for this country being way behind China in tech? How about you blame our largest technology company, Apple, who paid China billions of dollars, and they use billions of dollars, hundreds of billions of dollars, to buy back shares of their stock, rather than invest in research and development. Why? Because Tim Apple, well, he wants the $99 million package in compensation. That's why. And they want to dump stocks and become billionaires. Meanwhile, with all of these trillions of dollars that the Fed has printed so far, how come we have a higher stock market, a high real estate market, wealth among the oligarchs surging, but somehow you call Social Security and you have to wait for a month before somebody answers the call? How come some of these trillions did not go in improving Social Security services, DMV, USCIS? I think you know the answer, because money never goes there. And even if it does, they just waste it. And you wonder why when Charlie Munger says this inflation is going to cause perhaps the end of democracy. He's not joking. It could really happen. And this is why in this show we continue to inform the public and viewers about what's going on in the financial system, the financial markets, so people can be aware what's going on, and perhaps we can prevent the dire outlook that Munger is talking about. Anyhow, folks, I gotta move on here. Time is limited. Let's cover the market information for you, and we start with the performance of indices today. And here we go. The Dow Industrial Average down 622.24 points, or a decline of 1.78%. The Nasdaq down big 407.38 points, or a decline of 2.88%. The S&P 500 also down 94.75 points, or a decline of 2.12%. What about the sector's performance today? Leading the pack at number 1, capturing the gold, the silver, the bronze, consumer defensives, aka Walmart. Not really. It was Walmart, it was Coca-Cola, it was Procter & Gamble. We'll talk in the heat map analysis. But the laggards of the day led by technology, communication services, and cyclicals. What about the advance to decline ratios? NYSE 19% advancing versus 79% declining. NASDAQ 15% advancing versus a stunning 81% declining. Now, you and I know every time we have these exaggerated ratios to the downside, you're gonna get a pop in the futures at least, the pre-market session. Anyhow, moving on to futures, commodities. We talked about crude oil prices in the beginning of this video regarding the Iran deal. The WTI was down big, losing 4% today, while Brent took it on the chin, but a little lighter than the WTI and lost about 2% today. Gasoline was down, heating oil down, natural gas down. A bad day for energy futures. What about softs? Finally, we're seeing a softening of prices in lumber, down 2%. Likewise, we have a down day for coffee and cocoa. On the other hand, we're seeing gains for OJ, gaining almost 3% today, followed by sugar and cotton beat modest gains pretty much in the flat line. What about metals? Look at this. The old man is surging higher again, gaining a little over 1.5%. Silver, a decent day, gains of almost 1%. Platinum, palladium, specifically palladium, popping higher, 4% gains in palladium today alone. On the other hand, copper is the laggard, losing almost 1% today. What about meats? We have muted activities for live cattle futures. On the other hand, feeder cattle futures were down by a little over half a percentage point, while here it is, the new big tech, lean hogs, surging higher and gaining almost 2.25% today. Folks, stick with lean hogs. Forget about the old tech. It's all about the new big tech. What about grains? Decent day for wheat. We talked about wheat, palladium. When we have Russia, Ukraine tensions, wheat and palladium are going to move higher. Then we have gains for rough rice, almost 2% today to the upside. On the other hand, we have muted activities for soybeans, corn, canola. No major move one way or the other. Yet oats was the laggard today, losing almost 2% in today's session. Moving on to the options market, the big casino. What do we have here? Look at the volume down across the board. Is this a good sign for market bulls? Of course not. The call options buyers are nowhere to be found. Who's going to support this market higher? Anyhow, Apple came up at number 1. The hottest table in a quiet casino today, with a little over 850,000 contracts traded for the name today. Look at this, about 49.5% of those were calls. We're seeing more put options buying than calls, which is another leading indicator that we have another leg down in this market. Now, if the put options buying become extreme, we see more than 65-70% of the spread being put options, then it could serve as a contrarian indicator that perhaps we're closer to a bottom. We're not there yet. But here it is at number 2, Tesla, the souffle, with a little over 750,000 contracts. Once again, 48% of those were calls. So they're buying more puts this time around. What about number 3, Nvidia, with a little over 600,000 contracts traded today. The name was down big, over 7.5% in the red, yet they're still buying calls. In this case, 62%. The options traded for the name were calls. Moving on to the unusual activities that took place in the options market today. How about the ticker GLD for the gold ETF? Lots of bullishness for gold. The old man is sexy again. All of a sudden people remembered that we have gold as a store of value. Anyhow, they're buying upside calls for the GLD, this time around the $200 calls, with the expiration date April 14th. With expectations, the name could pop higher by more than 13% by then. They paid about 55 cents a piece to enter this trade, all in all spending about $1 million. And what about the trade for the ticker ARKF? This is once again for Tesla witch Cathie Wood, who, by the way, was on TV today on CNBC, and she was absolutely delusional. She predicts that RKK will recover, not just the highs, but then some. Inflation is not a risk. Matter of fact, the risk is for deflation. I mean, you want to talk about La La Land? Matter of fact, make it local land. Listen to that interview. Anyhow, they're buying puts on RKF, this time around the 28 puts for the expiration date March 18th. With expectations that the name could drop down by more than 7% by then. They paid about $1.25 a piece to enter this trade, all in all spending about $1.3 million. What about the trade for the ticker? IYR, this is the real estate ETF. If interest rates are moving higher, REITs will go down. So somebody is buying put options here. The 97 puts for the expiration date March 4th, with expectations that the IYR would drop by more than 5% by then. They paid about 75 cents a piece to enter this trade, all in all spending about $600,000. What about the ticker IWM for the Russell 2000? They're also buying puts, the 190 puts for the expiration date March 11th, with expectations that the Russell 2000 will drop by more than 5.5% by then. They paid about $2.60 a piece to enter this trade, all in all spending about $2 million. And at the bottom of the table, what about the ticker MRVL, Marvell? One of my favorite names, but I'm not sure you want to be in right now when we're giving haircuts to chips due to the rise in palladium prices. Anyhow, somebody's buying calls, this time around the 71 calls for the expiration date March 4th, with expectations that Marvell could climb higher by more than 5% by then. And they paid about $3.50 a piece to enter this trade, all in all spending about $2.3 million. Moving on to the heat map analysis. Oh boy, a bloodbath across the board, a sea of red, no mercy at all. But we have few exceptions, of course, due to earnings. Cisco lighting up green. We have DoorDash, decent day for Dash. But we're also seeing gold moving higher. It doesn't matter what you buy, gold miners across the board moved higher. We have fertilizer stocks, specifically Nutrien, moving higher. We continue to be bullish on fertilizer stocks. Big Pharma, not bad, specifically the high dividend names. A name that I own is AbbVie, the ticker ABBV. Yes, it was down, but it's still holding. You have the consumer staples, Walmart, Procter & Gamble, Coca-Cola, PepsiCo, Mondelez, all holding pretty good. So the message of the day from today's tape is you want to stick with the classic inflationary names. These are energy, materials, but the strategy has to also shift into dividend-paying names, old school cash kings, the likes of PepsiCo, Coca-Cola, Procter & Gamble, some of the big pharma names. These are names that investors are finding safe haven in while we see the rout and the volatility between the Fed's hawkishness, the Russia-Ukraine tensions. If you're looking for safety, dividend-paying stocks, old school, McDonald's is another name that holds pretty good historically speaking when we have high volatility. What about the heat map for the ETFs in the market? Again, a sea of red, a massacre across the board, unless if you had some of the inverse indices, the SQQs, the SPXU for the S&P 500, the SOXS, the inverse index for chips, the TZA, the inverse index for the IWM, any of the VIX proxies, VXX, UVXY. But look at this. Energy was not that bad. XOP, XLE. The XLE was down slightly, yet outperforming the market. Consumer staples, XLP was actually higher for the day. Utilities, another safe haven. I would avoid that one though because it is an alternative for bond yields. And so far we're seeing the 10-year yield and the likes moving higher. It was also a decent day for gold, whether we're talking about the IAU, GLD, GDX, all popping higher today. When we look at international markets, muted across the board, but perhaps we will see a bloodbath tomorrow as international markets follow the footsteps of U.S. markets. Now, let's talk about the EWZ for a bit here. A lot of you are asking me, are you going to buy the dip in the EWZ or not? Not right now. I think it went way higher, way overbought. It got to go down a little bit. And there is something else with the EWZ, the Brazilian market. We have an upcoming election, and this will cause a lot of volatility. So far, my reading of the market action, the psychology of the market is the market likes Lula, the comeback of Lula, even though his policies might not be favorable to corporations. But Bolsonaro, the so-called capitalist, was a disaster. But I have yet to confirm whether the market likes Lula or Bolsonaro. The EWZ was a disaster last year, but this year it is climbing higher, and the only catalyst I can find, besides commodities prices moving higher, is the fact that Lula has been advancing in the polls. I gotta see how the EWZ is gonna perform when Lula goes down in the polls. If we see the EWZ perhaps taking a massive leg down along with the dip in poll numbers for Lula, then I have a confirmation of what to work with here. For example, if I confirm this case, then if we see Lula advancing again, that would be a catalyst for me to buy the dip in the EWZ once again. Anyhow, you might ask, what do I care about the Brazilian market, bro? Let's move on. How about inflation? A lot of commodities that you consume come from Brazil. It's an important country. We got to talk about it. Anyhow, let's move on to the charts analysis, and we start with SPY, the S&P 500 30 minutes chart. I told you yesterday that I thought the pump from 443 is stupid due to the FOMC meeting. Why would we care about a lagging indicator? I mean, that statement was before the CPI, before the jobs report, before the PPI, so who cares? It doesn't matter at all. But this is a case that serves as an evidence that algos are indeed stupid. I talked about the behavioral element of the chart yesterday. We've already retested 443, and we climbed higher in the SPY. Why would you go down and retest 443 unless you're going to break below that number? That was baffling to me. And then came the algos with a stupid move, and what do you know, today we pretty much done what we should have done yesterday, erasing all of the pump from the FOMC and losing 443 as support. And now we're looking at 434 as support, and the resistance remains at 438. Look folks, I'm not going to do anything here in terms of buying the dip unless I see how the SPY's chart reacts around 430, my line in the sand. If we get a bounce and a confirmation, then fine, I'll buy the dip. But absent of that, no way. Moving on to the daily chart for the continuous contract for the S&P 500. Again, we have the double top. We lost the support, the very important support of 4,472. Yesterday, the bulls had some hope as the candle, the daily candle, bumped its head against that level, the very important level. And the assumption was that there is enough energy to break above that number and recapture it as support once again. Today we got the answer. The bears said not so fast. Have you heard about Russia-Ukraine? We're going down. And now we're retesting 4,384.5. So far, this is not holding. If it doesn't hold, we're going down to 4,232. I mean, when you look at it, what if this is an ABC pattern? We saw the A leg, we finished with the B, and now we're forming the C leg all the way down to 4,232. When we look at the momentum indicators, they are stalling, but look at the MACD indicator. It is curling down, forming a red impression on the histogram, once again confirming the weakness that we're seeing in the charts. Look at the volume, climbing slightly higher on the downside. This is a good sign for the bears that we are just seeing the beginning of another leg of a sell-off. The bears absolutely crushed it today. The bulls have no advantage whatsoever from the tape that we got today. The bears are in full control once again. And to confirm that, let's look at the SPX, the cash index, a daily chart, and no. Look at the chart. It got rejected again from the 200 days moving average. Not a good look here at all. We got a rejection the first time around. The chart was able to climb that. Then we got the double top. Then we formed the bear flag. And the chart appeared that it is climbing the 200 days moving average. But now we know that the bear flag is playing out, and we got another leg down, losing once and for all the 200 days moving average. What does that mean? If that holds by the end of the week, sooner or later, we're going down to retest 4,000 as support. Moving on to the Qs, the NASDAQ 30 minutes chart. Similar story here. We had the bear flag, the consolidation at 352, and it was baffling to me. Why would you go down there when you've already done a successful retest of that level? You only go down there if you're going to break below the number 352. Then came the FOMC, and you know the story. The algos are dumb. Today we're correcting what the algos should have never done in yesterday's tape. And now we're looking down at the support of 343. The resistance remains at 352. And notice the fact that the chart closed the gap, yet it did not bounce after closing the gap. Matter of fact, closed the day below the gap. This is a very good sign for NASDAQ bears. Moving on to the daily chart for the continuous contract for the NASDAQ. We have a triangle consolidation pattern. Did we break one way or the other? Not really. But is the consolidation for now favors the bulls or the bears? The answer is it favors the bears because we're getting really close to break the triangle pattern to the downside. We've already lost the support of the very important number, 14,445. So the bears gained significant advantage today. The question is, what if this is a reverse ABC pattern? Then we're going down to retest 13,000 13,599. You can round that up to 13,600. Now, when we look at the momentum indicators, they are stalling and curling their way to the downside. This is a good sign for the bears, bad sign for the bulls. Likewise, the volume is climbing higher, slightly higher, on a down day. This is a really good sign for market bears because it is an indicator that we are just starting the action to the downside. So once again, even in this chart, the bears are now in full control. When we look at the NDX, a daily chart, using the 200 days moving average, we're not even close. The SPY, at least, we had some hope that the SPY could climb above the 200 days moving average. The NDX, the Nasdaq, never made it there. It kept getting rejected over and over and over again. What is the downside target, you might ask? I have already discussed that in a previous video using the Fibonacci levels. Anyhow, we're moving on to the IWM, a 30 minutes chart. Similar story here. We're just undoing what the algos, I should say, did yesterday, losing the support of 204.5. Now, the good news for the Russell 2000 bulls is the following. Unlike the Qs, the IWM did not close the gap yet, so there is still hope that the IWM could close the gap and then bounce higher. The Qs closed the gap and then closed the day below the gap. So for now, the target for the IWM is closing the gap. We're not going to talk about 196.5 until and unless the IWM closes the gap and it fails to bounce from that point on. Now, the problem for the Russell 2000 bulls is the following. When we zoom out to a weekly chart, for the Russell 2000, as you can see, we have a consolidation range, 2100 as support, 2360 as resistance. We've already broken to the downside, broken the consolidation range to the downside. In typical charting behavior, the chart goes up, retraces the move to retest 2100 as resistance. So far, the chart is failing to reclaim 2100 as support. What does that mean? It means in the next few weeks, we will see another leg down in the Russell 2000 because we're seeing a bear flag pattern. How far down are we going to go, you might ask? Here it is, using the Fibonacci levels. How about going down in the extreme case, of course, another 23.5%. Now, mind you, this is the extreme bear case, not the mean one. Moving on to the Dixie Dollar Index, a daily chart. What's going on here? We're seeing a bear flag playing out, losing the support of 96. So the outlook for now is perhaps the dollar is going to go down. And gold already confirmed that gold would not rally if it's not sure that the dollar is going to go down. But the dollar bulls will fight back and say we have a trend with a support line. We have yet to break below this trend. The bulls could also argue, what if this is an ABC pattern? We got the A leg, now we're forming the B. Soon enough, the chart will pop higher, forming the C leg. Another way you could look at it is a bull flag consolidation. So for now, the bears have a case, the bulls have a case. The bullish case will go out of the window if the trend line is broken. The bear case will go out of the window if the Dixie recaptures 96 as support once again. And here it is, gold. The old man is sexy again. Look at this. Give us the Peter Schiff with the laser beams. Here we go. One more time. Because gold is breaking out, folks. This is a great development for gold. The gold bugs have been waiting for over a year now. And finally, we're seeing a move higher in gold, breaking a descending line of resistance that has been with us for over a year now. This is a significant technical development for gold. What about a daily chart for the 10-year yield? It is moving down, yet not losing the support of 1.94%. The tailwinds are so strong for the US 10-year yield to move higher, but so are the headwinds from the Russia-Ukraine tensions. More escalation, perhaps an invasion, will move the 10-year yield down. Why? Because the outlook for inflation will move higher, as we see palladium, wheat, perhaps crude, and natural gas move higher, pushing inflation higher. But now, bond market investors will have to do the math. If inflation is going to move way out of whack, then the Fed will have no choice to be even more aggressive. Forget about 50 basis points. We might even get a point, 100 basis points in March. If that happens, a recession is pretty much inevitable at that point. And if a recession is on the horizon, the 10-year is also a pulse for the pace of economic growth. So it's going to move down, but again, it's a battle between the tailwinds and the headwinds. We talked about the fact that the 10-year could move higher for the good reasons, meaning the outlook for growth. It could also move higher for the bad reasons, meaning more inflation expectations. And I discussed that in details in a previous video. What about the TLT? The TLT bugs finally catching a break. After a successful retest of 134.5, we're seeing the chart bouncing higher again. Now the test is, could it move higher to close the week above 140? Because that would be a major victory for TLT bugs. Moving on to the VIX 4 hours chart. What's going on here? The dip in the VIX, the red impressions on the histogram of the MACD of the VIX from a 4 hours perspective did not live for too long. We're now seeing another surge higher, and we're seeing a little baby tiny green impression in the histogram, confirming that perhaps what we're seeing in the VIX is a formation of an ABC pattern, which will take us all the way to 33. On top of that, we have 1 day before the weekly closing. Can the VIX really lose a lot of momentum and close below 20 for the week? I doubt it. So from the get-go, this is a major victory for market bears and options holders, because we've been holding on these options and the implied volatility been going down. Now the implied volatility is surging higher, appreciating those options premiums handsomely. What about the VXN 4 hours chart for the VIX of the Nasdaq? Similar story here. Look at the MACD indicator. It's curling its way higher again, producing green impressions on the histogram, and these impressions are getting larger and larger. This is a bad sign for Nasdaq bulls, good sign for Nasdaq bears. And again, the question is, what if what we're seeing right now is a formation of an ABC pattern, which will take us all the way to perhaps 45 on the VXN. Nasdaq bulls will not be out of the woods until the VXN closes the week below 27.5. What about Apple? What's going on here? A bad tape for Apple. We have a red impression in the histogram of the MACD confirming that the bullish momentum is over. We're now shifting into bearish momentum. The chart lost 172.4. The volume is moving higher. On a down day, the RSI is curling its way to the downside back into negative divergence. All of these are bad signs for Apple bulls, good signs for Apple bears. And once again, as Apple goes, so will the market. Tesla, the souffle and hourly chart. What's going on here? Forget about the bull flag. False. The bears were right that this is a false breakout, a cheat, and you're going down below the trend line once again. So bye-bye, bull flag. And we're now looking at the gap of 876. That is target number 1. If the chart closes the gap and it fails to bounce higher, the bears will double down. And oh boy, if the chart closes the week below the trend line, of course the bears are going to double down. But here's the thing for the bears. When I say double down, it doesn't mean opening more contracts. Because if you have the March contracts, sure, the prices might have gotten a lot cheaper and you might add to your holdings. But you gotta assess the risk here. What if Tesla pops higher? For whatever reason. After all, this is the Tony Montana stock. So doubling down doesn't mean opening more contracts. It could be closing those contracts and opening a longer dated expiration date when it comes to puts, meaning buying April puts, May puts. That is also doubling down. But you gotta wait for the weekly closing. If it happens below the trend line, you got a confirmation to do that. And by the way, we have a lot of bad news for Tesla pretty much every single day. But today it involved Reverend Elon Musk himself. And boy, was Reverend Elon busy or not today. He tweeted a meme where he compared the Canadian tyrant, Justina, to the guy with the funny mustache. You don't want to do that. I mean, I did it using a meme, but I'm just a douchebag from YouTube. Nobody cares what I say or what I do. But when you're the richest man in the world with such influence, you don't want to do that, Elon. Bad move. They're going to cancel you. And it didn't stop there, by the way. Elon got in a rift again with Biden. Biden said that we're supporting EV manufacturers in America. Elon replied and said that Tesla is the most American car out there. And by the most American car, he meant the most Chinese car. But anyways, it didn't stop here. Reverend Elon was fighting the woke crowd. He was fighting Biden. And he was also fighting the SEC. Elon Musk says that the SEC trying to gag him, taking away his freedom of speech, yada, yada, yada. And I say, they're not really taking your freedom of speech. They're taking your ability to scam investors into frauds. A lot of young retail investors, by the way, followed your scams and they bought Doge on the day of Saturday Night Live, which was the top, by the way, and they're now down over 80%. What do you say to those people, by the way, Reverend Elon? And don't be too concerned about the SEC. They're not going to do anything. The SEC remains in a coma. More bad news for the souffle. The headline reads, Tesla phantom braking complaints spark federal probe of over 416,000 cars. And it gets even better for the souffle. Tesla sank toward the bottom of Consumer Reports' newest annual auto brand rankings, weighted down by poorly received design changes and reliability problems. You want to talk about a recall after recall after recall. On top of that, we know that Tesla is making last-minute runs to Home Depot to patch up the cars so they can meet the quotas. We're producing more cars than Toyota, than Ford, than GM, even with the supply chain problems. Of course you are, because you're making last-minute runs to Home Depot. And now everybody's surprised that Teslas have quality problems. And here's the last shoe for the souffle that dropped today. The Ford Mustang Mach-E usurps Tesla Model 3 as Consumer Reports' top EV pick for the year. So Elon was absolutely pissed off today, fighting the SEC, fighting Biden, fighting the woke crowd, fighting the Consumer Report. I almost felt bad for him. But anyways, moving on to tulips, BTC, not a good day here, folks. 42,000 is lost to support, and the bull flag is now down the toilet. Goodbye. We actually have a double top. Meaning we're going down to 35,750 once again. The momentum indicators are curling down. Investors are starting to feel that perhaps gold is indeed the hedge against inflation, not tulips. So BTC is going down here, absent of a rescue mission. Some whale comes out and buys Bitcoin, but the retail crowd is not buying. They're holding massive bags. Who's gonna buy? The whales are not gonna step up here and buy. Believe me. And oh, by the way, here's the sentiment indicator for you when it comes to cryptos. The headline reads, most crypto investors would not sell, even if prices crashed 80%, and nearly half have made trading a new career or are considering it. This is according to Douchebank. Again, I say watch what they do, not what they say. Somebody's dumping here. Of course they're selling. Only the hardcore pumpers, who by the way bought way down there, are saying we're not going to sell. The majority of mom and pops are getting scared and they're dumping. And as far as making trading a full-time job, forget about it. We heard the same story back in the dot-com bubble. When folks quit their jobs and they believed that they're geniuses buying the hottest dot-com stocks were the new Warren Buffett bro. What do you know? They lost all their money. They used margin. Matter of fact, by the end of it, they actually owed money to the brokers, and they had to take the jobs at McDonald's. We're going to see the same thing here. No, it's not different this time around. Lastly, what about AMC apes? What's going on here? It wasn't a bad day for AMC, believe it or not. Matter of fact, it was trading in the green. And then it got really sour. The sentiment got really sour, and we saw some selling. But all in all, the retest of 21 as resistance is still on the table. It could happen. It got a lot weaker today. The odds of that happening got a lot weaker, but it is still intact, because all in all, you could look at this as a cup and handle formation, meaning it could give it another shot to crack above 21. When do we say that it's over, we're done here? If the support of 17.5 is broken and AMC closes the week below this number, then we'll know that the cup and handle broken and the coffee was too hot. Anyways, moving on to the conclusion of this video. What do we have on the economic calendar tomorrow? We have existing home sales, and then we have some Fed zombies speaking. Governor Waller tilts a little hawkish, and then we have the king of the doves, New York Fed President Williams. On top of that, the vice chair, Governor Brain Dead. Lastly, what do we have on the earnings calendar? We have John Deere, highly important earnings due to the labor strike. Are we seeing an impact or not? Wage inflation, but most importantly, the pricing power. Is it still intact? And if it is, then we have yet another leading indicator that the inflation in grains and food prices will continue to be with us for a longer time. And with that, folks, I'm done here. This is all I got for you for now. Thank you for listening. Thank you for watching. I will talk to you again tomorrow.